Hello everyone and welcome to another one of my projects. This one is aimed towards beginners and it is on crypto trading, since I've seen a lot of people want to get into cryptocurrencies and into trading but don't know how to actually do it. So first of all, my name is Ilya, better known as CryptoNap, and yeah, let's move on. So what will we do today? So first of all, we will look at the definition of trading. So you will learn, or we will learn together, what trading is. We will learn the difference between buying and selling, longing and shorting. You may not have heard about the longing and shorting, but we will cover that as well. We will also make a difference between investing and trading because most of the people actually use these use these terms interchangeably, but they are definitely not interchangeable. There's different analysis going into these two, and they are a whole lot different than many people think. Then we're going to look at what technical analysis, fundamental analysis, and sentiment analysis are. And lastly, we will of course learn some new terms, and that will be about it for this session. So first of all, what is trading? Now, cryptocurrency trading, since we're focusing on cryptos right here, so crypto trading is frequent buying and selling of a certain cryptocurrency. Now, if we were talking about trading in general, it would be any asset, any commodity, any currency. Right now, it's only about cryptocurrencies. So, as we said, it's frequent buying and selling, and depending on how frequent it is and how long we stay in a position, um, we can actually differentiate four types of traders. So what do I mean by the length or the duration of the position? First of all, what is a position? It means from the point of your buying or selling. So once you have your position, it's called so when you want the price to go up or to go down, you have to buy or you have to short sell, which we will cover later. And once you actually invest your money into that um, buying or short selling, you are in a position. Now, depending on how long that position lasts, we can be a scalp trader, a day trader, a swing trader, and a position trader. So first of all, scalping or scalp trading. This is the most well. These require a lot of actually fast trades, and these are usually not done by humans. These are usually done by machines. Um, these are positions that stay in for a certain amount of seconds or minutes. So those are very short trades that are aimed of basically getting that small percentage many times over. Now we have day traders. Day traders, many people are actually aspiring to be day traders, and that is okay, that is certainly decent, but it takes a lot of commitment, and day trading is definitely not a part-time job. So day trading is definitely not a part-time job because it takes a lot of looking into your charts, a lot of analyzing, and it's all about that one moment where when you can buy. So it's very hard and it's very time consuming. Day traders are usually, well, that's why they're called day traders. Day traders are not holding their positions longer than one day, or they're not holding their positions overnight. Now, if we have stock markets usually close. So they have a start and they have an opening time and a closing time. Now cryptocurrencies, they do not. So what day trading means in here is a bit different than what it means in stock market trading, let's say, because there is no start and no end to a cryptocurrency trading day. But let's say we can actually associate day trading to holding a position that day traders are not holding a long or a short position overnight or when they go to bed. So they are there until they are there. When they leave, their position leaves with them, and that's it. Now, swing trading is a bit different. Swing trading is actually trading that takes a certain amount of days or weeks. It's a bit less technical, so you don't have to look at charts that much, and it's a lot more fundamental. And then we have, of course, position trading, which takes several weeks or even months. Now, position trading can be associated with investing because it's a very long time while you're holding a position. Um, but now there are differences that we're gonna talk about because position trading is, again, as every form of trading, there to make a percentage gain and for us to leave the position, while investing does not necessarily need a stock, or in this case a cryptocurrency, to rise in value. That's not really an investment. So excuse me for a second. Then, where can we actually trade? So we're gonna talk about that a lot in the next session, but right now we have two types of places that we're gonna trade. So first off, there's gonna be regular exchanges, which just make us trade our fiat currencies, so dollar, euro, yen, or whatever, into cryptocurrencies, or they're gonna make us trade one cryptocurrency into another. And then you have BitMEX. Now, why is BitMEX special? So, BitMEX is the highest volume exchange. Well, if we're talking about regular exchanges, Binance is the highest volume exchange, and volume just means how much money is transacted during a day, week, month, year. So Binance is the biggest, but then we have BitMEX, which has more volume, but it's not all real volume because they're gonna offer leveraged positions or margin positions, which means that with $1,000 you can actually enter a position that's up to 100 times more than yours. We're gonna talk about that later. This is just an overview. Then we're gonna talk, well, we should talk right now about profits when you're trading and about the 90% rule. So, first of all, many people are expecting these grand profits, these Lamborghinis, big houses, permanent vacations, and things like that. Now, it's definitely not like that. I mean, first of all, this is a place where you devote your capital and then you get returns. So without a good investment, so without a good starting bit of or amount of money, you're not going to get anything. Also, there's a 90% rule which is hovering around. I'm not sure if the statistic is right, but it sounds very right. And it's basically claiming that 90% of the people lose 90% of their money in 90 days. So I mean, that's a real eye opener. It means that, as with any business and as with any job, you actually need to know what you're doing. You need to devote yourself fully and to immerse yourself in the crypto markets in order to actually profit. And I mean, why would it be any different than with any other job? I mean, it involves money. It People are trying to make some money, to create some value, and that's about it. I mean, why wouldn't people fail? 90% of startups fail when we're talking about business. Why wouldn't the 90% of the people that are starting in cryptocurrency trading fail as well? I mean, that's simple math. Now, what we are interested in is becoming uh, a member of the 10%, right? We want to learn as much as we can. We have to fail. Like, don't be afraid of failing. I actually encourage people to fail because failing is a part of the thing. And it's one thing to fail while trading without money, and it's a whole nother thing when you're failing, when you're actually devoting your money, because you have emotions playing out, and this is a very emotional game. Because people are emotional beings. Actually they cannot exclude emotions from anything that they're doing. And when you're devoting a certain amount of capital, you're exposed to major gains and major losses. Now, of course, we can manage the losses, we can manage the risk that we're playing with, but of course there's going to be emotions involved. And now we have to talk about the speed of the markets. So, as far as that's concerned, now many when we look at stock markets, we can look at the most famous index in there, which is S&P 500, and that is 500 uh, top companies in the US and their index, so their average. Now, the average gain per year of that index is 8 to 10%. Now, let's look at cryptocurrencies. How much did Bitcoin actually gain last year? How much will it gain this year? How much did it gain 2 years ago, 3 years ago, 7 years ago? These markets are moving so fast. And cryptocurrency markets are, let's be honest, one of the youngest markets. They're not as regulated as anything else. They have a lot of risk potentials. They have scams. Um, they have some people that are trying to take your money away. But also, it has such a great gain potential. It's such a revolutionary technology, and it offers so much to people who are immersed in these crypto markets, especially when trading, because you can see the moves easily. Well, when you know what you're doing, you can see the moves in crypto markets and in stock markets and in futures markets, depending on what you're trading. But in here, the trades actually unfold so much faster, and it just makes if you're good again, it makes the amount of time you need to gain much money uh, a lot less. So you need less time to gain more money because the markets are faster. Now, moving on from what trading is, we can look at what can we do while we're trading. So we can buy and sell, of course. Buying simply means that we are buying a cryptocurrency. Selling means that we are selling a cryptocurrency that we already have. Now, we have two terms that many people don't know that have not traded yet, and those are longs and shorts, or longing and shorting a cryptocurrency. Now, longing just means buying. Those are interchangeable, so you can use both buy and long. Those two mean the same. Now, as far as selling and shorting, which is also called short selling, is, well, they can be the same and they can be interchangeable, but not every time. Now, what does this mean? Selling usually means that you are selling a cryptocurrency that you already have, while shorting means that you don't have any cryptocurrencies, but you can enter a short position, which means that you are betting that the cryptocurrency will go down in price. Now, how does that work? Short selling is basically not a very difficult concept to understand, but kind of a difficult concept to explain. So let's say we're trading on Binance. Well, we can't actually short on Binance. Let's try trading on BitMEX, and we want to short Bitcoin. It means that BitMEX is borrowing us Bitcoin, and we're selling Bitcoin immediately, and then we are rebuying it at a certain price and returning it to BitMEX. The net gain or the net loss will be our loss. So um, that is short selling in a nutshell. Now it's way easier to just think of it as betting that the price will go down, because you don't actually do any of the borrowing, selling, buying back, and returning that we were talking about. You're actually just entering a position. It's, instead of a green position, it's a red position. It says short, and you gain money when the cryptocurrency is going down instead of when it's going up. You are realizing those gains, and you're actually having a gain once you close the position, and that's it. And also, we have a question that many people who are looking at day traders, they're asking this question a lot, and that is, how many monitors do you need? Because they saw all those day traders with 4, 6, I don't know, 7 monitors. They're looking they're looking at all sorts of things and everything. You don't need those, so you only need really one monitor. You can fit everything inside your one monitor screen, and that is completely perfect. So you don't need to spend any money in the equipment, in the hardware. All you need to do is learn how to trade. And that is not an easy task, but it is a manageable task. Now, what we have in here is the difference between investing and trading. So first of all, we have to think about what those two terms mean. So we've explained trading already, that trading is high frequency buying and selling of a cryptocurrency. Now, investing is the opposite. Investing is putting money into a cryptocurrency and leaving it for a year, 2 years, 5 years, 10 years. And we actually don't care what the price is. So first of all, we have the position duration, which is much longer in investing than in trading. Then we have the care for current prices, as I've said in here. And that means that when you're investing, you care less about the current price. So you don't really know, I mean, you can analyze and you can see if the price of a cryptocurrency is undervalued, overvalued, or at the approximately right price. But when you're investing, you don't actually care about that. You care about the potential, the future potential. So you are investing in something because you believe that it will change the world, and then it will increase in price over a long period of time, and not that it will increase in price in the next day, week, or month. So that is investing. Now we have different analysis, of course, because you're not looking at the same thing, you're not going to analyze the same thing. Trading is usually mostly um, analyzing a stock technically. So going to a chart, you're using those indicators and you're making a decision based on what the indicators tell you, and you're actually entering a trade. When you're investing, you're looking at the fundamentals, and that means what is the idea? How is the idea gonna be handled? What's the team behind it? How are they gonna handle it? So you're looking at the bigger picture in here. While when you're trading, you're looking at a really small frame. You're just caring about the momentum that's gonna happen. And then of course you have the different styles of, I mean, trading and investing are definitely different styles of putting your money into something. And trading is a much easier way to lose your money, but trading also has higher potential profits, while investing will definitely have lower profits. Let's say a professional investor will have less profits than a professional trader, but investing is much safer, and it can be considered um, a part-time job, or you can just look at something, be a bit knowledgeable, and then invest in it and hope for the best. While when you're trading, you have to be fully immersed into it, and you don't have time to slip up and to actually do bad. As far as analysis goes, when trading when trading is well when we're talking about trading, we have technical analysis, fundamental analysis, and sentiment analysis. Now, trading is mostly focusing on technical analysis, which, as we said, is looking at charts, putting indicators on charts, and then predicting where the price will go based on the patterns that we saw. As far as chart analysis and technical analysis goes, we're going to cover that in 2 sessions, so in our third session. Of course, this is just the basics, so this session is only covering what it all means and how we can look at it as a whole, so how we can look at trading as a whole, and we're not getting in depth at any of the analysis yet. Of course, you have to be patient since this is a very sensitive subject. Now you have fundamental analysis, which is, again, as I said, an analysis of the fundamental concepts. So the idea, the partnerships, the team, or whatever the project has. So that is the fundamental analysis. We also, in the fundamental analysis, have market acceptance or market traction, which means um, how many people are supporting the project. We have the let's say SEO, if we're talking about some ICO or some new project, so how many visitors there are on the website, or how long have they stayed, have they interacted with the website, or have they just left, which is called a bounce rate. So we have a lot of things in the fundamental analysis that we can look at. Of course, in the technical analysis, I don't want to go into indicators a lot, but we can look at the average price of a certain period, we can look at the how low is the price currently, or how away it is from its all-time highs. We can look at some chart patterns, and we have a lot of them, like flag patterns, like triangle patterns, like head and shoulders. We have Fibonacci retracements, we have support and resistance lines. Again, we're gonna cover that later, but there are a lot of things that we can learn in there. And of course, we have sentiment analysis, which means what is the market saying? Is the market inclined to buy this or to sell this? Is the market thinking that the price is gonna go up or gonna go down? Now, there are two parts, two components to sentiment analysis, and that is looking at smart money and looking at dumb money. So when you're looking at smart money, you're looking at institutional investments, at the banks, the hedge funds, the investment funds. So these people, or these companies, you're gonna look at that, and you're gonna see the direction. So right now, if you're looking at cryptocurrencies, you see all those institutions coming in. When you're looking at dumb money, and smart money and dumb money are kind of colloquial colloquial wordings towards institutional money and just normal person's money. Now, dumb money means just money of the masses, and people are usually very sentiment driven, and that's what happened with the bubble during December, January of well, December of the last year, and then January of 2018. So that's when the bubble kind of has popped. But before that, let's say 15th of December, somewhere around December, like there was so much hype around cryptocurrencies, and those were not institutions, those were just normal people. For an example, in the time span of 15 days, I received about 20 calls from my friends asking me how to invest in the cryptocurrencies, telling me that they have heard about Bitcoin or Ethereum or any other cryptocurrency and how it's going to be so good and how they're going to earn so much money. They just need a little bit of help. So I started talking about them, and I saw that they have no clue what they're talking about, but they're still devoting their cash into it. And that's when you realize that you have to act with the smart money, and you have to act opposite to dumb money. And that's how I actually exited and sold all my Bitcoin when it was time. So I sold it at around 18,000, and then I rebought somewhere around 10,000, 8, all the way up to, well, all the way down to 6,000. So um, so yeah, I made a lot of gains back then, and it was only because of the sentiment analysis. Now, of course, we're going to look at the last topic today, which is going to be the basic terminology. We've already talked about buying and longing, which are interchangeable. We also talked about selling and shorting, or short selling, which may be interchangeable but also may not be, depending on what we're talking about. And now we have a new term. It's called the order book. Now, what is the order book? An order book is simply, you can actually see it in BitMEX or Binance or any other exchange. And it will be a window. It is basically a window comprised of people that are trying to sell and buy um, a certain cryptocurrency at that time, at different prices, of course. And we're going to see how much money is, let's say, buying Bitcoin at 10,000, or how much money is selling Bitcoin at 11,000, or, whatever we have there. Now we're going to look at market buy, limit buy, and stop loss. So when we're actually buying something or selling something, we have different ways to buy it. And the first one would be market buy and market sell. Now, what does that mean? It means that someone already, well, let's focus on Bitcoin for now. So when we're trying to market buy or market sell, it means that someone already is trying to sell at that price, and you're just buying his Bitcoin, or he's trying to buy Bitcoin and you're trying to sell at that price. So you're actually filling his order. So you're filling the order of someone else. Now you have limit buy and limit sell, which is the opposite. which means that no one is buying and selling at that price, but you're gonna put your buy order at a certain price or your sell order at a certain price. When the price reaches that amount, you're gonna get your order filled. Now, this means that you can get your order filled fully or you can get it filled partially, depending on how many people are actually buying or selling at that time. And you also have a stop loss. And stop loss is something optional, but it is a very valuable tool when you're trading. So what happens is you're going to enter a position. It doesn't matter if it's a long position or a short position. So you're entering some position and you want a cryptocurrency to go up or to go down. Now, what happens if it goes the opposite way? So you're starting to lose money. You can actually set a stop loss, which means that you will automatically exit a position at a certain price, and it will prevent you from further losing money. So that is what stop loss is. Now we also have liquidation, which is which is a different term, but is very connected to stop loss. So before covering liquidation, we have to cover leverage and margin. Now, we already talked a bit about it, but both leverage and margin means that when you devote a certain amount of capital, you can get matched with a certain amount by the exchange. And that's what BitMEX does. So if you, let's say, have $1,000 on BitMEX and you want to trade with $1,000, you can actually enter a trade with 100 times more than what you have. Of course, if you're entering, so that's called leverage, and that's called 100x. Now you can enter a position with exactly $1,000 that you have. So if the price drops $1, you're losing $1. But if you're entering with 100x or with 100 times leverage, if the price drops 1%, you're going to lose all of your money. And when you lose all of your money, that is called liquidation. So when you're using leverage or margin, you cannot go below what you actually have. So you cannot go into debt. You cannot owe the exchange anything. So you can only lose as much as you have, but you can actually use their money to gain more. So when you're entering your leveraged position, they're actually going to give you a liquidation price, which means that if a price reaches that point, you have lost everything you have. And that brings us to position sizing, which means how much you're actually going to invest and how much leverage you're going to use in order to have a normal liquidation point. Now, you will do that. You will actually estimate your liquidation. They will tell you your liquidation point, but you will estimate where it will be based on your technical analysis, which we're going to talk about later. And then we have market depth. And what is market depth? You can see it pretty well because on BitMEX, because they have a pretty nice market depth. Well, a pretty visible market depth, and that is basically it will look like two colliding mountains, and then one mountain would be the buyers and one mountain would be the sellers. And how high the mountain is means how much money it goes into buying or how much money goes into selling, and that would be an indicator of what are the people doing at the moment. Are they mostly buying or are they mostly selling? Um, so I understand that this basic terminology will not click with you, even though it's basic. It will not click with you yet, and you will mostly not understand what I'm talking about yet. But hopefully, by the end of this project, you will understand everything, and then we can actually start with the intermediate. Intermediate classes where we're going to learn how to actually trade, how to analyze, and how to enter positions. So I would like to thank you for listening to me and for listening to this session. I will be back with you shortly, and yeah, I'll see you soon, guys. This was Ilya, better known as CryptoNap, and have a nice day. Bye bye. Hello everyone, I hope you are all doing great today. This is Ilya, better known as CryptoNap, and today we have a very interesting session. So this is again crypto trading for beginners. This is our second session, and it's going to be on platforms, on trading platforms. So what we're going to do today is we're going to see where you can trade and how you can trade, because certain traders have various goals. You can decide to maybe buy or sell your cryptocurrencies for fiat, so exchange them with fiat. And fiat is just money that we use, so let's say a dollar, euro, or yen. Next thing, we can exchange different cryptocurrencies, and we do these on exchanges on different platforms. Then also we have well, let's call it betting on a certain cryptocurrency going up or down, and we can do that by longing and shorting it. We can also trade derivatives. Now, I know that this might sound very complicated right now, but I'm gonna try to make it easier. So first of all, what is gonna be your goal while trading? As we said, we can buy and sell cryptocurrencies for fiat. So there are certain platforms like Kraken, like Coinbase, that allow people to, let's say, spend their dollars or euros and buy cryptocurrencies, or the other way around, that they can sell their cryptocurrencies for dollars or euros. Next thing, we can exchange cryptocurrencies. So let's say we can trade our Bitcoins for our Ethereums, or our Ethereums for our Bitcoins. Next thing, we can bet on the price of cryptocurrencies. So let's say we are expecting our Bitcoin to rise in value, and that's why we're gonna bet on it going up or bet on it going down. And next thing is, of course, we can trade derivatives. We can trade futures contracts, and again, we're gonna talk about them later, just so I don't confuse you right from the start. So first of all, let's go to our first section, which is fiat to crypto and crypto to fiat exchanges. Those are exchanges such as Kraken and such as Coinbase. Coinbase, of course, being the biggest one. So you can connect your account with your credit card, and you can exchange your fiat money for cryptocurrencies and your cryptocurrencies for your fiat money. Now, what is good with them and what is bad with them? Of course, we have a very good concept because we can buy and sell our cryptocurrencies for money that can be used whenever we want. But now the bad thing is that usually those exchanges have a bit higher fees, and you're going to lose out on a bit of your money while trading these. But that's, of course, that's usual. And of course, this is a bad thing mostly for people from the US, and that is transparency, because cryptocurrencies are made to be traded, exchanged, and transacted, but right now they are either not regulated or regulated but really badly. So US citizens have to pay taxes on their transactions of cryptocurrencies, and that's why exchanges such as Coinbase have to give out their customer list to the US, and the users are going to have to pay taxes. So that is a bad thing, but it cannot be avoided when you're using such exchanges. Now the next thing we have is crypto to crypto exchanges, and of course we're going to provide examples right as we finish with the presentation. Crypto to crypto exchanges are exchanges such as Poloniex, Bittrex, Cryptopia, of course the biggest one, Binance. They have various cryptocurrencies, hundreds even, and you can exchange one for another. Now there are usually main cryptocurrencies such as Bitcoin, almost always, well, yeah, almost always, then Ethereum, and then some others which may or may not be main currencies, and you can exchange these for your other cryptocurrencies. Now, of course, not all cryptocurrencies are listed on all exchanges. They have to be accepted by the exchanges, and that is done either by paying the exchange for the listing or by achieving a certain grade of popularity, or by having a certain protocol or
whatever the criteria is. But the thing is, if you want to trade a specific cryptocurrency, you have to find which exchanges support that particular cryptocurrency. Of course, we have to think about trading fees. Now, on these exchanges, trading fees are usually very small, and I would advise anyone and everyone to trade on Binance because it is the exchange with most volume, which means that the price that the sellers are offering and the price that the buyers are willing to pay is very similar to one another. And the difference between them is called spread. So the spread is very small, and also you can use their Binance coins to further reduce the fees and make the fees what 0.1% or something like that. It's a very small fee. Now, of course, this is the utilization of the native tokens. So exchanges such as Binance have Binance coin or Binance token, and it is used primarily. It is used exclusively on the Binance exchange, and it is used primarily to reduce the fees. You can use it to trade and gain some money by trading its volatility, but it's mostly used to reduce the fees while trading other cryptocurrencies for one another. Now, just a note off the top of my head, since cryptocurrencies are very early in the development and in the adoption, many of them do not have a use case. Binance Coin does have a use case, and this is the utility that it provides. So Binance Coin would be a very good investment. That's just an advice again. Now we have trading the volatility of cryptos, and volatility is nothing more than price fluctuations. And we can do that on the biggest exchange of this kind, which is BitMEX. We can trade it, so we can bet, let's say, Bitcoin going up or going down, and we can do it by longing and by shorting. We can, of course, trade volatility of cryptos in the future by trading futures, but we're going to talk about them later. And, of course, while trading on BitMEX or various platforms that allow this kind of trading, we can use leverage. Leverage is a separate topic. We're going to talk about it at the end of the presentation. I just wanted to give you a few examples of what those exchanges are and what you can do on them. Now, leverage trading. What is leverage trading? So it is a very good concept while you're trying to trade, and it is basically an exchange loaning you money to trade. So let's make an example. You have $100 and you want to trade on BitMEX. So you're going there and you are almost certain that Bitcoin is gonna go up in price. So you want to buy that Bitcoin, right? To long on Bitcoin, to be long on Bitcoin. Now, of course, with $100, if Bitcoin rises 10%, you're gonna get 10% of your $100, which is $10, and that is very good. But now, the exchange offers leverage, which means that you can have up to 100 times of your original investment, of your capital. So you can borrow from the exchange 100 times of that $100, which is very good. Now, let's say you're trading with 10 times leverage, which means you're trading with 10 times the amount that you have. You're trading with $1,000, and if Bitcoin goes up 10%, you are gonna get $100, right? Which is massive. Now the downside is if Bitcoin falls down 10%, you are gonna lose all your money. By all your money, I mean all $100 that you had, because what the exchange does not allow is it doesn't allow losers that are larger than your initial capital. So if you went in with $100, you can't lose more than $100, but you're just gonna lose them faster and you're gonna get more faster based on if you're right or wrong. Now, this of course imposes bigger risks and bigger opportunities. And it's all about how good you are at predicting market moves. Of course, we can talk about how good using leverage is, and I think that it's very useful, but there's a difference between useful leverage and a bad leverage, and that is the amount of leverage that you're using. So if we're talking about traders, traders are using 2 times, 3 times, 5 times. The riskiest amount, like the riskiest traders are going to use 10 times leverage, but no one in their right mind is going to use 100 times leverage, because a slight move of 1% is gonna destroy your whole investment, your whole portfolio, and that is completely like that is just nonsense, because when you're making an assumption, when you're making an analysis, you're not 100% correct in where the direction of a certain cryptocurrency is gonna go. Now, of course, as the last topic, we have derivative trading, and this is simply um, derivatives can be described. So first of all, they're not cryptocurrencies. Derivatives, trading cryptocurrency derivatives is not the same as trading cryptocurrencies. These are just, let's call them imaginary stocks. So let's call them imaginary stocks that reflect the price of cryptocurrencies. But buying them does not mean that you're actually buying cryptocurrencies. Now, they have their positive sides and their negative sides. The positive side is that they are extremely easy to buy. So there's no wait time, there's no additional fees usually. Usually exchanges that offer derivative trading are going to be more suitable. They're going to offer certain advantages to buying derivatives as opposed to buying real cryptocurrencies. But then again, you do not have the real cryptocurrency. Now, the bad thing is that um, uh, basically derivatives are centralized, so they are not cryptocurrencies, they are not decentralized, they are not autonomous, they are centralized. They also have no real value. Their price just reflects approximately the value of cryptocurrencies, or their pricing reflects the value of cryptocurrencies. And you can also look at futures trading, which is available at CBOE and CME. They offer basically that you're gonna bet on Bitcoin being up or down in the next week, 2 weeks, a month, so in the future. This is what futures trading is. And the easiest way to explain futures trading is actually by how it all began. So let's say you are a farmer and you grow some crops, and you don't know whether they're gonna be whether next year you're gonna sell them at $100 per kilogram or per pound, or at $1 per kilogram or pound, whatever you're using. So in order to know that, to have a certain to have a certainty, to have something safe, basically to have a safety net, you're gonna agree with the sellers. So all the sellers and all the buyers are gonna gather up in the market, and by the laws of supply and demand, or and they're gonna create the price in the future, and this is futures trading. So I hope that is all clear, and now I want to show you some of those exchanges that we were talking about. Now, let's move to Coinbase and Kraken. So this is basically Coinbase. Again, I'm not affiliated with any of these exchanges. I'm not promoting them. I'm just trying to showcase how you can do your transactions with cryptocurrencies. So this is Coinbase. You can make an account, and you can easily sell or buy your cryptos for fiat or back and forth. At the moment, Bitcoin's price is $6,633.29. You can also see the movement of Bitcoin at the moment, but yeah. Next thing we have Kraken, and Kraken is basically something similar to Coinbase, but the difference is you can also trade different pairs. So as you see, you can trade cryptocurrency pairs, but it is definitely less popular, but you have more options. You can also see the charts in here. If you click this button in here, you can see the charts. A widget is gonna pop up, so in your window is gonna pop up, and you can actually see this, the chart of, let's say, Bitcoin to euros right now. Next thing we have are traditional exchanges, so crypto to crypto exchanges, and one of such is Poloniex. Now, as you see, Poloniex in the upper right corner has main pairs that are Bitcoin, Ethereum, right? XMR, which is sorry, yeah, Ripple. No, Ripple is XRP. Sorry, Monero, and then Tether, US dollar Tether, and I keep replacing like XMR and XLM and XRP. I don't know why, but anyways, it's Bitcoin, Ethereum, Monero, and US dollar Tether, and you can actually exchange these main cryptocurrencies for any of the other cryptocurrencies that are in here. So as soon as you click on one of them, the chart is gonna pop up and you can buy them, sell them, or use a stop limit order. These are all the buy and sell orders, market depth, trade history. So you have all the data that you're gonna base your assumptions and your predictions on. And the next thing, and the main platform for trading definitely, is BitMEX. And if you're trying to trade a certain cryptocurrency's volatility or price movements, this is the place to go. So again, BitMEX is the exchange with the biggest volume in US dollars. And right now we're looking at Bitcoin chart. This is Bitcoin against the US dollar. And you can see the current price. You can also see right down there order book. So how much money is used to buy at certain prices. You can see the depth chart, which reflect these orders in two dimensions. You can see your positions, of course, if you log in and make an account. There are other cryptocurrencies in here, such as Cardano, Bitcoin Cash, EOS, Ethereum, Litecoin, Tron, and Ripple, but they definitely have a lot less volume and they have bigger spreads. They also have, as far as you see, some derivatives and some, let's call them futures contracts. But mainly this platform is being used for trading Bitcoin against US dollar and betting that it's gonna go up or down. So as far as exchanges are going, this is all for today. Next session is also going to be very interesting, and if I'm correct, it's going to be on trading indicators, and that's a very interesting topic because many people are getting confused on how to actually properly use indicators, what they are, how to combine them in order to get maximum results.
Hello everyone, this is Ilya, better known as CryptoNap, and today we have our third session of our crypto trading for beginners guide. Today we're going to talk about indicators, and this is only going to be a basic guide to trading cryptocurrencies and using indicators while trading them. Of course, we're going to have intermediate and expert sessions, but this one is going to be basic and it's going to be aimed towards beginners. Now, today we're going to cover a few topics. So first of all, we're going to talk about the difference between technical and fundamental analysis. Then we're going to talk about chart lines, indicators and oscillators, and patterns, which are tools that you can use in order to technically analyze cryptocurrency. Then we're going to talk about what works and what doesn't, along with time and price that we both, basically what we both need on the chart, since chart is a two-dimensional drawing. Then we're gonna show off my TradingView account and see some examples. Of course, we're gonna talk about trading algorithms as well, since they are quite popular right now, and we're gonna talk about long-short portfolios. And this is just one strategy that is very interesting. So moving on, technical versus fundamental analysis. Now there's a lot of things to say about this topic, but since we're focusing our session on the technical analysis, we're just gonna briefly go through this and through what differentiates them. So first we have fundamental analysis, which is trying to measure something, so trying to measure a price of a cryptocurrency or of an asset based on its intrinsic value and use cases. While technical analysis is looking into the history, and based on some statistical data and probability, we can determine where the price is going to go. Now, these are two very, very different approaches, and fundamental analysis, as good as it is, we cannot really determine the intrinsic value of cryptocurrencies right now because 99% of them do not have any use case. I mean, let's be honest, they don't have a use case, like only a few of them do. But for those that don't, we can of course use technical analysis. Now, what I wanted to say is that technical analysis is much better when working with cryptos as opposed to when trying to technically analyze a stock, a futures, contract, I don't know, options or anything else. Because first of all, we have a lot of volatility and a lot of spread in cryptocurrency trading. Second of all, it's very, very fast. Everything is very fast. Third, the average investor is far less educated, which means that our proper technical analysis can give us an edge, unlike in the real stock market. Uh, Now, let's move on from this and go straight to chart lines. So we're going to divide our tools into chart lines, oscillators and indicators, and patterns. First of all, as for the chart lines, those are just lines that we can draw on our crypto chart that react to basically the price reacts to those lines, and those can be trend lines. Well, they are usually trending, so if the price is going straight up or straight down with few downturns, those are going to be trend lines. And then we have stagnation lines, which are again going to be used as support and resistance lines. So those are going to be ranging. Those are going to be moving from, let's say, $1 to $1.2 back and forth. And a stock, usually, or cryptocurrency in this case, is usually trending about 20 to 25% of the time, and it's ranging in price about 70% of the time, 75% of the time. So that is a thing that we should know. Now, when establishing support and resistance lines, it is usually a line that the price has reacted to, so that has bounced off of in either way. We can draw it manually, but we can use a tool called Fibonacci retracement line, which is a very good tool in order to help us establish our support and our resistance. Now, of course, how do these lines actually work? So let's say in the history, $1 mark for a certain cryptocurrency was a breaking point. So whenever it reached $1, it bounced down. So it could not pass that line. It means that many people are going to expect that even the next time when it comes to $1, it is not going to pass that, and it means that they are going to set their sell orders right below $1. So when price approaches $1, it's going to trigger those orders and the price is going to fall back down. So that is basically how resistance works. Support works just the other way. It is extremely simple, though it is hard to understand in the beginning. Now, if we move to indicators and oscillators, we have, like, let's just say a few. We have our moving averages. We have our trading volume, our RSI, which is an oscillator. We can also add a few like Bollinger Bands or stochastic or Chaikin money flow, so whatever you have there. And those are statistical tools that we're going to use and implement into our chart to show us more data and to provide guidance when we're looking for something. Again, we're going to talk about this a lot more when we show a chart of a cryptocurrency, so I can explain it properly and so it becomes easier to understand. Then we have patterns, and patterns are nothing more than price oscillations that resemble, let's say, triangle, head and shoulders, cup and handle, or we have certain waves. I just noted in here the best example would be Elliott wave, and if the price follows a certain pattern, it is most likely to break out into a bullish trend or into a bearish trend. and this is one of the better ways to actually establish the future potential price movement. Now, as for what works and what doesn't, it is very simple. So first of all, many people are making a mistake of using only one oscillator, only one indicator, and trying to gauge whether the price will go either way. Now let's talk about this. First, a chart is a two-dimensional drawing. It has a y-axis and it has an x-axis. One presents time and one presents price. We need to have an indicator or oscillator that gives us a better glimpse at what the price does, as well as when the price does what it does. Now, besides that, we're going to use the tools and indicators that most people are using. And why is that? Because the more people use it, the more important it becomes, because it presents a bigger support or resistance tool. Now, of course, we have a notion that whatever the people do, so whatever an average investor does, we should do the opposite. Because um, what has been portrayed is that every single investor can be categorized as dumb money, and then every institutional investor should be categorized as smart money. Now, this sadly is very, very true. So if we look at CNBC, which reported on Bitcoin price movements, we actually have a chart that confirms that in over 90% of the time, 85 or 90% of the time, whenever they said a bullish news, Bitcoin went the other way. Whenever they said a bearish news, the Bitcoin went the other way. So this portrays what dumb money does, so following CNBC, and what smart money does, which is creating its own trends. And then, of course, long-short portfolios. This definitely works because let's look at what happens. If we think that Bitcoin will, so we did our technical analysis properly, there's a high probability that Bitcoin will go up, so we buy some Bitcoin. And then there's a high probability that Ripple will go up, so we buy Ripple. And then there's a high probability that let's say Ethereum will go up, so we buy Ethereum, and then Bitcoin Cash will go up, and we buy that as well. So our portfolio is a series of long orders. So we're betting that everything is going to go up. And let's think of the cryptocurrency market. It's all connected, it's all intertwined, and it's all following the price of Bitcoin, right? So what's going to happen? If let's say we are right about every one of those trades, great, we earned some money. But let's say we are right about every one of those trades except for Bitcoin, and Bitcoin falls in price. So we are right that they are undervalued. So Bitcoin Cash would be undervalued, Ripple would be undervalued, Ethereum would be undervalued. Of course, this is just hypothetical. But Bitcoin goes down, so what's going to happen to them? The rest of the cryptocurrencies that we bet that are going to go up are not going to go up anymore. They're going to go down because Bitcoin went down, because Bitcoin is the mothership, let's call him. So the mothership of cryptocurrencies. So we need to have a balance in our portfolio. We need to bet on something going up and on something going down equally, so we can negate fluctuations of the crypto market itself, and so we can bet only on what we know. That is a very important lesson that I actually learned the hard way. And lastly, we can talk about trading algorithms. So trading algorithms are nothing more than simple programs that connect through the API to our exchanges. They can use our funds to trade for us on a 24-hour, 7 days a week basis, let's say. They can be used from our computers or from virtual computers. And of course, they are going to trade they're going to trade based on how we tell them, so based on certain indicators and oscillators. The most popular trading algorithms are right now Gumbot, Profit Trailer, EonBot, and Hasbot. Now, Gumbot, of course, most popular, I would say one of the harder ones to use, but the best one.
It's the most expensive one, but it's also the best one because it provides most options. Profit Trailer, I would call it a beginner trading algorithm, a beginner bot. It picks the stocks for you, it picks cryptos for you, but it doesn't have as many options as Gumbot. EonBot is the cheap version of Gumbot, and then we have Hasbot, which is, well, Hasbot would be the most expensive for the base version, and it doesn't offer anything that good when we look at the previous three. Now, how do they work? As I said, they're connecting to your API. You choose their set of criteria, their indicators that they're gonna work with, and as soon as all the criteria are met, they're gonna buy cryptocurrencies. As soon as certain profit criteria are met, they're gonna sell those cryptocurrencies, and you're eventually, hopefully, gonna end up winning some money or earning some money. Now, how to properly use them? We of course cannot just use them, plug in our indicators and just hit trade because we're going to lose money that way. We need to backtest. So there are backtesting options on some of those. If not, there are on a website called TradingView, there are actually backtesting options for some of those bots. And backtesting is definitely crucial in finding the best strategy for the trading algorithm. Now, using trading algorithms is very good because it eliminates emotions. It eliminates emotions from everything, from the trading. But there's also a bad thing, a really bad thing, and that is you cannot short using them. You can only go long, and that is a very bad thing. And that would be it for the presentation. But let's move on to the chart. So, what is the chart telling us? This is a chart of Bitcoin and dollar, right? Let's move it to well, let's not move it to a smaller time frame. So first of all, what I wanted to say is chart lines, right? So we have those support and resistance lines that we can draw. So let's draw them like this. So first of all, we can see a clear line that would be something like this. It doesn't have to be exact. It's just a brief thing. But as you see, we can draw it like this, like this. We don't know exactly what's happening, but as you see, we are drawing some trend lines, and those can pose as supports or resistance. Now, what we can also do is, as I've said in here, we can use Fibonacci retracement, right? And that is a tool that on TradingView, which is by the way free, and it can also be paid if you want to use more indicators. So first of all, Fibonacci retracement in here, which based on the previous move, so based on a bullish or a bearish move, is going to show what kind of retracement we can expect. So let's say we want to see this bearish move. When will this bullish retracement end? So we're starting from the highest point, right? Which can be this one or this one, but I'm gonna be safe and do the red candle. And it's gonna go all the way to the bottom wick of the last candle. So look at what happens. These are the Fibonacci retracements. There was a full bullish move down, a full bearish move downwards, which is 100% retracement. It is a 100% move. Now, the cryptocurrency could have retraced 23.6%, which is the first line, 38.2%, which is the second line, 50%, which is the the third line, sorry, and then what? 61.8%, 78.6%, and again 100%. So this just establishes some support and resistance lines. Some of those are going to get neglected, some of those are going to get ignored, but then again, some of those are going to get a response. And based on that response, you can actually see what's going to happen. So probably, if we look at this now,
we have a resistance line of 7.3 thousand in here, and we have a support line of 7,080. Now, whether that will be appreciated or not, or whether the price will react to that line or not, we can look at a lower time frame, of course. But for the sakes of this video, I'm not going to show that. So now that we know what trend lines are, I'll just remove them so we can have a clear chart again. Once we know what they are, we can look at indicators and oscillators as well. So by right clicking, right? What's happening in here? This is strange. This is very strange. I cannot see. Oh, there it is. Okay, so I can add an indicator in here. As you see, I've already added two oscillators, which are RSI and Chaikin money flow. You don't need to worry about this one, actually. But we can add some indicators, and the most simple one is a moving average. So there are different moving averages. There are simple moving averages, there are smooth moving averages, there are exponential moving averages. There are of course others, but those three are the most important. Now, depending on what you want, it's basically if we want a simple moving average, it's very simple. So let's say we are on a 1-day time frame, and each one of these candles present 1 day. So if we have a 20-day moving average, simple moving average, it is just going to show us an average price for the last 20 candles. Now, if we take smooth or exponential moving average, it's going to add up a layer of complexity to the moving average, and it's going to value latest candles, so most recent candles, more than the previous ones. So let's try to add an exponential moving average for, let's say, 20 periods, which is in this case 20 days. So this is what it's going to show us. And this is the average for the last 20 candles from here, for the last 20 candles from here. So we can see the average. Now, many people are actually trading by using moving average crosses. So whenever a shorter moving average crosses a longer moving average, but those are not complete trading strategies. So yeah, I advise that you should implement something more. And we're going to talk about trading strategies a bit later. I just want to show you the indicators and the oscillators. So we are showing moving averages. We need to show trading volume and then RSI. So trading volume, again, this is the volume in here. So for every 1 day, as you see, we can see them in green and red, and it means at the end of the day it ended on red or on green. It ended in positive or in negative price-wise. And the height of this bar actually shows us how much volume has been traded, so how much money has been traded during that day. And we can actually use that when we're trying to analyze by testing what's happening before a spike up or before a spike down or before a crash down, let's call it. So is the volume going down and then suddenly going up? Is the volume keeping an upward pace, or what's happening? And then we're showing that, and as I said, since this chart is a two-dimensional drawing, we see price on one side and we see time on the other. Right at the bottom of the screen there's time. So we need to know what's happening through time if we ignore price, and that's what RSI is going to show us. Now, RSI is a statistical equation that basically shows us whether the price entered the overbought or oversold area. Overbought area is anything outside of the purple purple middle part, and oversold would be anything down. So anything below 30
is oversold and anything above 70 is overbought. Now this is definitely not an indicator that we should trade on, so it should not be used to solely to trade off of it, because it is horrible. I mean, it doesn't show what the price can do. Well, most of the time it does, but look at this. So we would actually buy in here based on it because it showed that it's oversold. But what happened in here is it went further down and it went further down. So it is up to a point showing us when the potential end can happen, but it's not actually showing us when the potential end is happening. We need to know that based on some other indicators, and RSI would just be a confirmation indicator. So we have that as well. And now we're going to move on to patterns. So let's go to patterns. Now again, I'm going to delete everything so we have a clear chart. Volume, volume, volume. Yeah, we're deleting volume as well. And now let's look at some patterns. So we have, let's say, a triangle pattern, and it doesn't need to be, I mean, we should draw it on the chart, but I just want to show you how it would look like. So it has 4 parts. This would basically be the price movement. So a price would need to move some like this, and the points where A, B, C, and D are the tops and the bottoms of the price. So this would actually be the price. After this, so basically how a triangle pattern works is that we're going to see the price movement, we're going to see that it's a triangle pattern, and at around 80% of the triangle, a price is going to break somewhere out. So once it breaks out, it's going to break out in here, or it's going to break out in here. So upwards or downwards. I mean, it's very simple. It doesn't have anywhere to go except upwards or downwards. And whether it breaks up or down, we're going to trade based on it. Now, when we're looking at what to trade on, we're supposed to determine the biggest trend lines first, then the support and resistance lines, of course. Then we're going to look at indicators, then we're going to confirm with oscillators, and then we're going to look at patterns, both chart patterns and candlestick patterns. So this is one of the chart patterns. The other one would be head and shoulders. I actually don't want to show you all the patterns. I mean, you can easily Google them, but let's say head and shoulders would look very much like head and shoulders. So we're gonna have a price that's going up and down, and then we have a price that's going further up, creating a higher high, right? And then we're gonna have the right shoulder. Now there are certain rules to patterns. So let's say we have a neckline that should be pretty similar in price. If it's a bullish if it is a bullish sign, then each bullish spike should be higher in volume and each bearish spike should be lower in volume. There is, of course, a reverse to this, which is reverse head and shoulders, which is just the other way around. And it sounds very much complicated when you put it like this, but if you learn one by one oscillator, one by one indicator, you learn how to use them, you understand the essence of them, and you try to understand what they're trying to portray price-wise, you can actually learn to use them all together, to spot them on the chart, and then to trade off of them, which is very, very intense at start, but very fun later on. We're gonna have, of course, cup and handle, Elliott wave, ABCD patterns. We're gonna have candlestick patterns as well, which are just patterns but on a smaller basically on a smaller base. Let's say we're gonna look at candlesticks, and we're gonna look at the few candlesticks that stick out and what they are doing. So based on that we can spot trend reversals or something else. So
As far as charting goes, that's what I wanted to show, and this would be the end of this session. I hope I didn't confuse you all with this because it's a very big topic and it cannot be covered in this small of a time frame. But of course, this is only the beginning. I will be having a lot more sessions on indicators specifically, and later on trading strategies and how to trade properly and how to use the indicators to trade properly. So yes, I hope this was fun and educational for you all. Again, this was Ilya, better known as CryptoNap, and I will see you soon. Bye bye. Hello everyone, this is Ilya, better known as CryptoNap, and today we're going to talk about trader's mentality and market manipulation. This is our fourth session of crypto trading for beginners. Now, what are we going to talk about exactly in today's session? So first we're going to talk about how we feel when we have consecutive losing streaks and what's our mentality. And then we're going to talk about perseverance and mind stability, which are going to counter our basically our personality and our emotions while trading. Then we're going to talk about practice through paper trading and how you can actually learn to avoid and learn to mitigate you being emotional while trading. We're going to talk about trading algorithms and how that can be an asset if you're too emotional while trading. And lastly, we're going to talk about long-short portfolios and how they are a very smart way to avoid any negative sides of trading, including, well, basically for cryptocurrencies, it's even more important. But we're going to talk about that a bit later. So first of all, we have consecutive losing streaks. So let's start off by saying this. So we're trading. Let's say we have a certain amount of capital dedicated towards trading, and we're winning. So let's say we find a nice strategy, and then we win our trade once, twice, three times. We're feeling strong, we're feeling powerful, we feel knowledgeable. But then what happens when you lose once? Well, you say, hey, it's nothing basically. I got my trade right three times. I lost one time. You know, it's good. I have my risk reward set up. I have everything set up, and it's all good. But what happens if you lose on a trade once, twice, three times, five times in a row, seven times in a row? You're gonna start feeling bad. You're gonna start questioning yourself. You're gonna feel that you're wrong. You're gonna feel that your strategy is wrong, maybe. So what can you do then? So what can you do about it? You're gonna start questioning yourself. You're gonna start retesting your strategies. You might find a worse strategy, you might find a better strategy, but in the process, you're probably gonna be worse off because you're gonna be testing all that stuff. You're gonna have insufficient data while testing, and you're gonna lose money. You're gonna lose confidence with losing money, and it's gonna be a hard period. Now, what can you do about it? First of all, you have backtesting as a solution. Second of all, you have to improve your mentality. So let's talk about this a little bit more. First, I wanna talk about the mentality. So before we're choosing a strategy to trade with, we have to know that it's good enough. We have to backtest it in all of the scenarios, in a bear trend, in a bull trend, in a ranging or a consolidation. Well, let's call it a trend. Um, so we have to know how it's behaving in all these situations before we're actually engaging the trading with our own money, you know. So if we know that our strategy is good, then we need to convince ourselves that if we lose five times or seven times or 10 times in a row, it's just a game of chance. We have a better chance of winning, we have a good risk reward ratio, but something happened in the process. So it can be two things. It can be just chance, you know, you can just lose 10 times in a row and then you can win 20 times in a row. It doesn't really matter. And then the second thing is markets have changed. In cryptocurrencies, you can see markets changing by looking at if any big investors have actually invested and are trading, and if just retail traders are trading. You can look at how many hedge funds there are and how many retail traders there are. Usually, markets do not change. An average investor does not change. So usually, it's just being a game of chance. If you have uh, a good strategy, if you made good calls, but you just have a losing streak. It's very, very heavy to get out of that bad mindset once you get into it. You're really gonna doubt yourself, but this is key to trading, and this is what separates good traders from bad traders. Now, the second thing is we can start backtesting again. So we can backtest our strategy before trying out new ones. We can backtest it again and again and again on as many cryptocurrencies as possible in as many scenarios as possible. And that is probably the ideal way to overcome our fear and our doubts that we have in our minds. Now, as far as perseverance and mind stability goes, this is what we have to train in order to not fall in the bad emotional streak while we're having a losing streak. So, first of all, we have to know that emotionless trading is impossible. We cannot be detached from our emotions while trading, not even when trading with someone else's money. So, first of all, we can use capital that we're comfortable with. If you have your life savings of, let's say, $10,000, don't put it all in trading. I mean, you might fail, you might lose it all. Sure, you might 10x it, so you might increase it tenfold, but then again, you might not. So use capital that you're comfortable with. If you lose it all, it should not affect you at all. It should be just a process of learning how to trade. So if you lose it all, you should say to yourself, well, I lost this portion of my money, but then again, I learned something from it. Of course, as I said, we can backtest strategies as well. We can try to bring our strategies to perfection. And of course, no strategies will be perfect. No strategy will be a 100% winning strategy. But then again, we can bring it as close as we can. Now, we also have to know that we cannot expect 40% gain or 100% gain or even 10% gain on every single trade if we have a very safe strategy. We can expect small consecutive gains. So if we choose a strategy that wins us more often, it's going to win us less in each trade. And that's very simple. That's just a trade-off that we're having. The more opportunity you have, the more risk you have. And that's just how it goes. Of course, we shouldn't think that our strategy is bad just because we had a few consecutive losses. I mean, it's that simple. We've put so much time in our strategy. We put so much time into thinking how it works. We backtested it numerous times, like infinite times. We saw how it behaves in bear markets, in bull markets, in consolidation trends. So everything. We saw how it performs. So what if we lose a few trades in a row? We have to think like that, or we can just give people our money, you know? We can go to a person on the street and give them all our money, and it's gonna save us the trouble of banging our head into the wall. Um, you're just not gonna win if you're in a bad emotional state. You're not gonna earn any money. Now let's talk about paper trading, and this is actually a very neglected and a very underrated part of trading, because many people want to earn money, they want to earn money fast, they want to find that perfect strategy, but they don't want to put work into it. They don't want to develop themselves as traders, as thinkers, as analysts. And that's impossible. Like, you cannot win if you don't develop yourself, if you don't adapt yourself. So paper trading is a great learning tool. Now TradingView offers paper trading. Many other trading softwares also offer paper trading, but TradingView happens to be free, so we can backtest everything there. So we can test out the waters. We can go in and get comfortable with trading, with charting, with using indicators. We can actually have that fake money that comes with paper trading. So we can set up our fake portfolio that doesn't actually trade with money, and we can do our trades. We can see how our strategy behaves in real time and not only in backtesting. We can see how we behave because we have to think that that is real money. We have to learn how not to use, like how not to be emotional. If we're emotional while paper trading, what do you think is going to happen if we're trading with real money? We need to detach emotions from trading, even though we cannot. We need to try to be as detached as possible from our emotions, especially from our negative emotions, but then positive emotions are also bad because they encourage us to take much more risk, and that can be bad as well. We have to be calculated. We have to be machines. Speaking of machines, we have trading algorithms, but they are not the perfect solution. So first of all, what are trading algorithms? These are simply mathematical algorithms that, depending on, so they can be bought, they can be programmed. You can find many online, either for free, for a small price, for a big price. It just depends on the algorithm. It's a mathematical algorithm, uh, and basically what it does is you set it up to it usually connects to an exchange through an API. Um, it has the access to your portfolio, to your funds actually. You set up which trading pairs you're gonna trade. You set up how it's gonna trade it. So you set up what indicators it's gonna use, what values it's gonna use, and based on that, it's gonna trade, and it's not gonna ask any questions. So no questions asked. It's gonna do whatever it's told. It's completely emotionless. It's completely automated, and it works 24/7 because it can be set up on a physical computer and on a virtual computer. Now, what are bad things about trading algorithms, or bots, short for robots basically? So the main thing that's bad about them is that most of them do not have a shorting function. And that is bad because cryptocurrencies as a whole are currently in a bear market, and you usually want to trade in the direction of the trend. So if you can only go long and it's a bear market, you have much bigger chance of losing your money. So basically, since everything, or almost everything, is pegged in its price to Bitcoin, if you do any kind of trade and then Bitcoin goes down, you're basically gonna fail. You're gonna lose money. And that is, of course, a bad thing. You might get a bit emotional even while you're not trading, even if you're not trading personally. There are a few bots that I've heard of that have the function to both go long and go short, but I have not tried them. I have tried only a few bots, such as Gumbot, Profit Trailer, EonBot, Hasbot. I've tried those. Those are very good, very useful. You can actually backtest everything if you have a bit of coding experience and a bit of experience in Python. That's what I did. So I backtested everything. I found a few profitable strategies, and I ran the bots. Now, what I didn't do is I didn't let it sit for 24/7, so for an infinite amount of time. I didn't let it sit like that and just trade to infinity, because it would lose me money in a case of cryptocurrency price as a whole, so a market as a whole going down. Now what I did is, when I saw a bullish trend, I turned it on. When I saw a bearish trend, I turned it off. But then again, that had me do the analysis, do the technical analysis, the fundamental analysis, the sentiment analysis, and had me make conclusions about whether the market as a whole is going to go up or down. Now that is one bad thing about bots, is that they have to be babysitted, basically. Even if you look at top trading firms, top investment banks, let's look at Goldman Sachs. Let's say they're managing, I don't know how many billions of dollars. Their trader desks are actually not trading. Their algorithms are trading, and they have brought their algorithms to almost perfection. But their traders are actually sitting on the computers, and whenever an algorithm is popping an error, they're just fixing an error and turning the algorithm back on. So that's what you're going to have to do. You're going to have to put out fires. That's what you're here for. Now, I prefer trading to trading algorithms, but that is just me. Some people are going to be much more analytical and they want something emotionless, and they're going to try trading algorithms and they're going to like it. I was very much into trading algorithms, but I always kept trading myself because I found that I could have an edge while trading myself. And lastly, we're going to talk about long-short portfolios. And this is something that hedge funds have actually made popular, and it is a very simple strategy. So we know that cryptocurrencies are very volatile, and that is great. And why is it great? Because they're fluctuating. We have a lot of risk, but we have a lot of opportunity. Now, everything is pegged to Bitcoin price-wise. So whatever we trade, we have to take into account what is Bitcoin doing. Is Bitcoin falling? Is Bitcoin rising? Is that cryptocurrency that we're investing in gonna outperform Bitcoin, or is it gonna underperform Bitcoin? Because if it's gonna underperform Bitcoin, we should just put our money in Bitcoin and never trade, right? So this is why we're having long-short portfolios. This means that if we have, let's say, $100 to trade, we're gonna put equal amounts into cryptocurrencies that we expect are gonna basically gain price, and we're gonna put an equal amount in cryptocurrencies that we expect to lose price. So we are gonna long with $50 and short with $50. This is gonna mitigate any market movements, and this is only gonna bring us profits if we actually get it right. If the cryptocurrencies that we longed actually outperform, and if the cryptocurrencies that we went short actually go down more than the market does. This means that we have to be good at analysis and that we have to take very calculated positions. But then again, we have far, far less risk when we're talking about especially cryptocurrencies, because we have to track so many things, and then on top of that we have to track Bitcoin's movement. So this is a very, very good strategy, and one that I'm implementing right now. Again, this means that um, you just overall have to be right in a certain percentage of uh, of positions in order to be profitable. It's not gonna be amazing profits. It's not gonna be big profits. Well, it might be, but it's usually something um, much more manageable. So we're reducing risk, but we are reducing the reward potential, of course. Now, this is not for everyone. People like to be day traders. People like to scalp. So people like to enter a position and leave the position in the same minute, hour, day. This is only for people that are keeping portfolios. So people that are investing for a week, 2 weeks, a month, a year, 5 years. This is how you maintain your wealth regardless of the market moves. Now, as far as trading goes, there are many things that you can do, and long-short portfolio management is not something I would advise. But when it comes to actual investing, long-short portfolios are a great risk management tool. So this is basically what I've had for today and for our fourth session. We're gonna have a fifth session very soon. It's gonna be very, very interesting. And then we're probably gonna have a bonus session, and um, we're gonna end this series um, with that bonus session. So again, thanks for watching. Thanks for listening. This was Ilya, better known as CryptoNap, and I will see you very soon. Bye bye. Hello everyone, this is Ilya, better known as CryptoNap, and welcome to Crypto Trading for Beginners. This is, again, our fourth session, session 4.1, and this is going to be on market manipulation. Now, I've set this as a separate session because I actually didn't want to put the first part of our fourth session into this. Market manipulation is a topic on its own, and I wanted to hit it separately. So in today's session, we're going to talk about market manipulation. What is it? Who manipulates the market, and why do they do it? And how can you actually profit from it? We're also going to talk about ICO manipulation. So first of all, what is market manipulation? Market manipulation is simply changing the sentiment of the market by faking data. This means that some people can fake certain orders. They're going to fake some data in order to trick the market into thinking that certain cryptocurrency is going to go up or down. So the first and the biggest actually The biggest way to do it, the most known way to do it, is spoofing orders. So if we look at biggest exchanges, we can always see the order book when we can actually see each price in segments and how much money is actually around that price. So how many orders, what is the value of the orders at a certain price. So wealthy individuals, wealthy groups, or institutions can actually put enormous orders to be acting as barriers, as shields. And people are going to see it, they're going to see that barrier, and they're going to say, oh wait, the normal money cannot pass through that, let's go the other way because it's going to turn around. So they're changing the sentiment, the price is actually starting to go the other way, they are removing that order, and they're going along with the rest of the market, therefore making profits. We're also going to talk about news and influencers because this is the second part of market manipulation. Now, if we look at CNBC, if we look at some certain YouTubers, if we look at certain articles, they are actually not accurate. They're far from accurate. And some of them are accurate on purpose, some of them are inaccurate on purpose. Now, inaccuracy on purpose is basically the same part as the same thing as spoofing orders. It's faking data, so it's making people think something else. It's changing their opinions, and then it's doing the opposite thing. So people are earning money by either doing a certain thing. So let's say CNBC. There has been a certain analysis that say that in 85 or 80%, 87%, something like that, of what CMB has said about Bitcoin, the complete opposite has happened. So whenever they said that Bitcoin is in a bad state, it went up. Whenever it said that Bitcoin is in a good state, it went down. So that is one part, and the other part is the influencers that are mostly gonna promote something in order for it to gain price and to gain volume, users. They're usually going to promote something like um, a very small market cap cryptocurrency, a very unknown cryptocurrency. They're going to talk about it and they're going to shill it. They're usually having big Telegram groups, big Discord groups, and big groups on social media in general. They're going to say this is going to spike up so much, then people are going to invest. But the thing is, those influencers are already investing. So that is also a form of market manipulation. They're going to invest before everyone, they're gonna market that coin, they're gonna leave before everyone, and when everyone sees that there's nothing behind the cryptocurrency, it's gonna sell out, people are gonna lose money, but the original investor, the original influencer, is gonna earn a lot of money. And the third part is, of course, ICO manipulation or shilling, and we're gonna talk about that a bit later. So, who does market manipulation and why do they do it? It's very simple. Institutions do it, wealthy individuals do it, groups do it, groups with either a lot of wealth or with a lot of presence, social media presence, with a big following, because those are the people that can actually do it. Now, as an individual, you cannot really manipulate prices with limited portfolio, with limited funds that you have, with limited presence, market presence that you have. But if you have a large market presence, whether financially or reputationally, you can actually influence the markets in the way that you want. The reason for it, of course, the main one is profits. People want to earn money, and they're not afraid to do whatever it takes to earn money. The second one is agenda, and that can be a debated one. Um, Many people are saying that governments or certain institutions or banks, let's say, have a reason for cryptocurrencies not to succeed. Therefore, they have an agenda to bring it down and they're manipulating the prices down. So that is the second thing. It's very debatable, but I just wanted to put it there. And of course, now we're going to talk about ICO manipulation because it's a bit of a separate topic. Again, who is doing that? As with normal cryptocurrencies price manipulations, it's being done by, well, less by institutions and more by wealthy individuals, wealthy groups, and influential groups. It's done first for instant profits and second for investment profits. Now, when it comes to instant profits, we've seen some influencers receiving money before actually investing, so they're not actually promoting it, so their investment is going to increase in value. They got money to promote it. They got cold hard cash to promote it, and that's why they have instant profits. And meanwhile, they can also invest, so when the ICO reaches exchanges, when it rises in price, they can actually profit that way as well. Now, is this unethical, the whole market manipulation thing? Sure it is. Are people gonna do it? Sure they are. But you actually have to think about how to profit from it. Now, if we're talking about influencers, you have to be extremely early when they're announcing things, when they're saying that something will go uh, up, when something's going to go to moon. You have to be an early investor, because when the bulk of the people invest, it's already going to be too late. So you have to be extremely early. When it comes to institutions, just when trading, do not really believe those fake orders and fake order walls, but it's going to be hard to avoid those, and it's going to be hard not to believe in the data that you have in front of yourself. So that is something you have to overcome and find a solution to. So yeah, this was a very quick session. I hope you like it, and I will see you very soon. Again, this was Ilya, better known as CryptoNap, and thank you for watching. Known as CryptoNap, and welcome to the fifth and final series of crypto trading for beginners. Today we're going to talk about practice, paper trading, and a few beginner trading scenarios. So, as I said, we're going to talk about the TradingView platform as a free platform that we can practice on. We're going to talk about paper trading, and I'm going to show you how to do it on TradingView, and we're also going to show a few trading indicators. Moving on, so first we're going to go through the presentation, and then I'm going to do the actual showing of the TradingView platform. First of all, what can it be used for? So it can be used for many things. It has a basic plan which is completely free, and then if you want to use more indicators simultaneously, if you want to use it for alerts or anything else, it is gonna cost a bit, but it is what it is. I think the starting cost would be $19.99 a month or something, but you can get everything for free. So first of all, we are going to use it for backtesting. We're going to use it, well, we can use it for running a bot, but you need a paid version for that because it needs to fire off alerts. It can be used for paper trading, and it's completely free, and it can be used for gathering information, and I'm going to show you how to do that in just a few minutes. So first of all, paper trading, again, we all know what it is. It's trading with fake money. Now what we need to know is we can do a few things with paper trading on this platform. So we can of course go long, we can go short, we can sell, we can buy. Oh, I'm sorry, I don't think we can go short with cryptocurrencies. I'm not quite sure on that actually. But what I wanted to note is that you need to use the relatable dollar amount to you. So if you're planning to invest $2,000 in the near future, or let's say $2,000 for now, you should actually use $2,000 in your paper trading account so it feels more realistic, because we're trying to recreate everything as if we're trading with real money. So that is the most important thing, because the default for TradingView is actually 100,000 units or dollars, and it can be quite unrelatable because you see your gains, you see your losses, you see them huge, and it's not really a representation of how you're gonna feel when you win or when you lose some money while you're trading. So you need to have something relatable, something to ground you, and something to make you a bit emotional so you know how to overcome your emotions. Of course, as for trading scenarios, we're going to go through three of them. So we're going to try to show how to trade averages, so average lines. We're going to show Fibonacci retracements and how to trade those, and we're going to trade on divergences. Of course, the best thing would be including a few or all of these indicators in one. Of course, as far as trading scenarios go, there are many good trading strategies, and people, a lot of people actually are using different trading strategies. It's not like there's one that's profitable and the rest aren't. But I think that this is for another session or another project because it's a major topic, and trading scenarios and trading strategies can actually, I can talk about it for as many hours as you want, and I don't think that I will do it justice by talking about it for 5 minutes or 10 minutes, and I want to devote a series to trading strategies, and I want to go through many indicators and how people can use them, when it's the right situation and when it's the wrong situation to use them, and to lean on these. So that being said, I want to move on. And I want to show you, this is a weird video, okay. I was actually looking for a drop shipping guide because I'm trying e-commerce as well, but that is completely unrelated. It's just related to the video that just popped up there. So let's move on. This is TradingView. So what can we see in here? This is the main page of TradingView, and you see the most popular authors, and you see them trading something, right? So there's Bitcoin dollar trading scenario, Euro to what's called Switzerland's franc. Then we have again Bitcoin to US dollar. So there are many things in here. You can actually filter them, and you can filter them by cryptocurrencies, currencies, or whatever you have. You can actually filter them by a special cryptocurrency. So you can go into, let's say, Bitcoin US dollar, and you can see all of the most recent and most popular ideas in here. See, they're getting liked, they're getting commented on. You can see the views as well. They're showing various strategies and various analysis. So the top authors first, you can see the when it's posted, and you can see what's expected. You can see the general overview of a certain cryptocurrency, so whether people think that it will be bearish or bullish, as you see, and you can see some news in here. So as you see, it's a pretty broad platform, TradingView, but what we're gonna focus on is the charts, right? So let's hop on to Bitcoin US dollar chart, let's say. Okay, there we go. So let us do this, and this is a normal one-day Bitcoin to US dollar chart. Now I have a few indicators in here, but for this analysis we're just gonna use RSI. Let me just actually manually delete these so I can show you everything I want, and so I can draw properly without this distracting you. Okay, there we go. So when it comes to the free plan, you can use up to 3 indicators, right? And this is why I decided to show you how to trade with only 3 indicators, one being RSI, second one and the third one being averages, your averages. So we're gonna insert indicators, which is right here, and we're gonna type, let's say, so there are, as we actually saw in the previous sessions, we can use weight moving average, we can use exponential moving average, and we can use simple moving averages. We are gonna use exponential moving averages, right? Or so exponential moving averages. There we go. And we're going to use 2 of them. Now there are actually indicators that include both of these, so you can actually, with a free account, access one more indicator, and I would probably put volume in there. But yeah. So let's put one to, let's say, 50, and let's put the other one to, I don't know, 21, let's say. Okay, there we go. So if we're moving down to, let's say, a 1-hour chart, or even so a 15-minute chart, because we're trying to day trade, right? We're trying to pop up some trades. We can see that I'm going to change their colors as well. So this one will be yellow. Okay, there we go. So the 50 moving average would be the yellow one, and the 21 moving average would be the blue one. Now what we're seeing is the average price of the past 21 candles and the past 50 candles. And of course they're fluctuating, they're crossing each other. And what we can do is we can actually trade their crossings, you know. So as you see, their crossings are announcing that something will happen. So a longer EMA, in this case the yellow one, is showing a longer trend, apologies, and it's reacting very slowly to the movements, while the faster moving average, or the 21, the blue one, is reacting much faster. Now this would be even better if we actually traded something like this. So if we had a 50 moving average and a 7 moving average, let's say, and we can look at what's actually happening. So now if we're going basic, let's say, we can trade every time this short moving average is crossing upwards. We can actually buy something, and whenever it crosses down, we can actually sell something. But that is too basic, and we're actually going to lose money on it. So many people are trying to trade averages. That's not going to happen like this. There are a few scenarios where trading moving averages works, but there are much better scenarios. Why I wanted to point this out is because even though it's not usually not a profitable trading scenario, I wanted to show it to you because many people, many influencers, many YouTubers, many, on every platform, let's say, are gonna try to push some trading strategies, and they are usually not gonna be profitable. They're usually gonna be bad, and they're not something that works in this space at this time. And one of them, and one of the most popular ones, is actually this one. Now, what can we actually use moving averages for, in my opinion? And that is tracking trends, tracking major crossings. So what I would do is I would put a 100 moving average and a 200 moving average, let's say, and I would also put a 50-day moving average, and I would look at the 1 hour, 2 hours, 4 hours, 1 day moving chart, and then I would see the crossings and see the general major trend. Now this would be an indicator of something horrible happening, or something turning into a let's say a bearish trend. Now this is what happened in here, right? The shorter one, the yellow one, crossed the longer one, and this is actually, so what happened was the mid-December bounced down, then we were consolidating a bit, and we thought, well, maybe we're gonna go up, but with this was the confirmation actually. So right here, this was the confirmation that we weren't actually going up. So this is a very delayed indicator, 100 candles and 200 candles delayed almost, but it is what it is. We can use it to track something down, to look for trading opportunities, and it would usually be used as a confirmation indicator, so to confirm what you're thinking rather to trade on it. Now, what can you trade on? Look at this. We can trade on, oops, my bad, we can trade on, where are you? There we go. Fibonacci retracements. Now, what are Fibonacci retracements? So we already talked about support and resistance lines, and what Fibonacci retracements are basically their principles. So we all know who Fibonacci was and how his sequence and how Fibonacci numbers work. They're basically creating a perfect sequence. Now what Fibonacci retracements are trying to do is, once we discover the beginning of the trend and the end of the trend, so this is the lowest point of the trend, let's say, so this one right here, we can actually pull them and we can see how much is most likely for the move to retrace, because when there's an action there should be a reaction, right? And in most cases we can see a reaction of it going up. Now we don't know yet if this trend is over, but once the trend is over, we can do our Fibonacci retracements and see if the cryptocurrency price will move up 23% from the drop, 32.8% of the drop, 50% of the drop, 61.8% of the drop, which is this line, 78.6% of the drop, or a full 100%, which is a complete retracement. Now, of course, people are gonna teach, and many people know about this tool, but not many people actually know how to trade it. So what will they tell you? You see a trend. So our major trend is bearish. We're trading with the trend. But let's look at this. So we have our major trend, which is bearish, right? And then we have a retracement. Let's say that we want to trade a retracement even though we're in a bearish scenario. We want to go long, we want to buy Bitcoin, and we want to find an opportunity. Okay, so we're trying to see where it retraces to, right? We need to know our target. Or even better, if we're in a bearish trend as we are now, we are looking for the price bounce. So will the retracement stop here or here or here? What is going to happen in the future? What we need to know is that we have our confirmation indicators. Also, we have our volume, which is going to confirm that the buyers have stopped purchasing with great strength, or that the sellers have stopped selling with great strength. Now, what I like to do is I really love to pair this trading indicator, well, let's call it indicator, this trading tool, so Fibonacci retracements, with divergences. And what are divergences? So basically, I'm going to draw it out for you because it's easier to see like that. So let's say that the price is going up, right? Okay, the price is going up, but what is happening to the RSI? Like, this is a completely improvised scenario. I'm not looking at the chart or at the price at the moment. And let's say I'm just gonna write actually price. Okay, it's going up. And then we have our RSI, which is this indicator in here that's showing what's oversold, what's overbought. Of course, it's really not a perfect indicator, but it can be used in this case as a perfect indicator alongside Fibonacci retracements. So what's happening now is that RSI is, as you see on the chart, usually following the pricing movement. But if the price starts going up, let's say, and RSI goes down, so goes the opposite way, or in another case, the price may go down and RSI may go up, right? So this is a divergence, and this is a very, very strong signal. Now, there are a few rules. So first we have a bearish and a bullish divergence. So if the price is going down, let's say, and the RSI starts going up, this is a bullish divergence. If the price is going up and the RSI starts going down, it means that this is a bearish divergence, right? It means that the buyers, in this case, it means that the buyers have basically lost their strength. Now, if we pair this with some ranging indicator, so we can basically pair it up. Like, let's put it like this. We know that a divergence is a strong indicator of a movement in the opposite direction. So once this happens, what is expected is the price to fall down. In another case, if the price is falling down and RSI is going up, what's expected is the price to shoot up. It's not going to happen every time though. And why is it not going to happen every time? It's because divergences happen. They happen on many time frames. They happen in many occasions. But what is going to help us decide if a divergence is tradable or not? Well, support and resistances. if it happens, like if the price is somewhere in here and the divergence happens, it's in the middle of nowhere. Like there's a good chance that the divergence will actually be responded to price-wise. But we don't need to risk that. We don't need to risk that at all. Now, if a divergence happens somewhere along the lines of support and resistance zones, now this is a very good and a very tradable opportunity, and we have to use it like that. So all I wanted to say is that the chart is two-dimensional. We have time. We also have price movements. We need to include both of them in order to find a tradable solution. We also don't trade off of one indicator. We have uh, indicators that are showing us support and resistance zones. We have our confirmation indicators, we have our volume indicators, and what we really need to do is find our best strategy. Now, I want to talk a bit more about TradingView and what you can do with it. Now, there are many charts you can actually check in here. You can use different type of candles. You can use every single formation, indicator, or anything you want really. Now, what's really nice about this is that people can create indicators. They are also including many indicators and creating scripts. And these scripts are actually used by bots very often. So you can actually use a bot, something like, let's say, Gumbot, which is including these scripts. So once you have a script and you have a bot, you can, let's say, add an indicator. So these are scripts, and I have a few of them. So let's say we want to see this one. Uh, not a great one to actually show as an example. Let's try a different one. Yeah, we can try heartbeat script, right? Yeah, so this is a very colorful script anyways, but the scripts are usually including many things, and they're showing buy and sell signals. Based on that, you're going to have an analytic of what's happening and how you can profit, or if you can profit, you know. So this is a very interesting thing. Now, yeah, so it would look something like this. So it would show you where you're gonna buy, and it will show you where you're gonna sell. Now some scripts are better, some scripts are worse, but what's important is you can actually program it so you can automatically trade without you actually trading. You can program your bot to trade off these scripts. You don't even know, you don't even need to know how they're made or what indicators they have. So all you need to have is a good script, a profitable script, and a script that was backtested a lot of times and on a lot of scenarios. So that is what I wanted to talk about. You can also use this platform to follow other traders that you like and respect, and you can follow their signals. So that is one more thing. Now, the thing that we're here for is paper trading, and it's very simple to access paper trading. It's right on the bottom, right? So you're entering your paper trading, and you can actually go in here. You can reset your paper trading account, and let's say you want to trade with $2,000. So you're gonna put 2,000 in here, right? And there we go. Our account balance is 2,000. Now you can begin your paper trading journey. So you are gonna go here. So you're gonna right click anywhere on the chart. You're gonna trade, and you're gonna buy or you're gonna sell. These are just quick buttons. You can buy and you can sell your current cryptocurrency chart that you're on, or you can create a new order. So you see you have your asks and your bids, so your sells and your buys. You have your orders that you can have a market order, a limit order, and a stop order. You can use a stop loss if you want, and you can automatically take profit if you want as well. There is also a duration that you can actually put in here, which is quite nice. So there are many options, and you can test this out. You can see if if your strategies are actually good or if they're not. You can see if you begin to be emotional, and you can see how to overcome emotions. Now, I talked a lot about emotions in our fourth session, so our last session before this. You can actually check it out, and you can see what I'm advising on how to overcome either fear or anxiety or rage or self-doubt when you're trading and when you're on a losing streak. I'm also talking about winning streaks and how you can um, have your ego inflated and how that's also bad for trading and how you can overcome that. So to just sum it up, there are a lot of trading strategies. I've shown you one that I really like. I also have talked a lot about TradingView. I showed you how to paper trade, and I advise everyone to start off with paper trading rather than trading with real money, because they're going to get discouraged really fast if they're trading with real money. Like, trading is actually a science. It's an art. It's something you should devote yourself to if you want to trade like this. If you want to invest, now that's something else that can be much more passive. It takes a lot less time. But if you really want to trade, you have to devote yourself to this. So start off paper trading, start off small, learn how to do it, learn the ropes, get comfortable with the UI, get comfortable with the website, and then you can progress to trading with real money. That being said, thank you for watching. This was Ilya this was Ilya, better known as CryptoNap. And yeah, thanks for watching. This was our last session, and I will see you in the next project. Have a nice day. Bye. Everyone, this is Ilya, better known as CryptoNap, and this is our quick summary of crypto trading for beginners. So in our sessions, we had 6 sessions in total. Our first session was what is trading? We talked about the definition of trading, buying and selling, shorting and longing, and our basic terminology. Second session was a summary of what you can do and where you can trade. It was touching upon exchanges, copy traders, and leverage trading. Our third session was the indicator basic session. We talked about indicators, oscillators, as well as tools, and we had a few trading scenarios there. Our fourth session was on mind stability and trader's mentality. We talked about losing streaks, we talked about perseverance, mind stability, and we talked about how practice through paper trading helps with your mind stability and emotional stability. Our fourth session was a bonus session. Sorry, this was a fifth session actually, but it was called session 4.1 because it was a bonus session. We talked about market manipulation, what it was, who manipulated the markets, and why did they do it at. We also talked about how we can profit from them. And our last session was on TradingView. We showed TradingView platform. We talked about how paper trading works. We talked about how paper trading works, especially on TradingView platform. And we actually discussed about a few trading scenarios that can be followed and that are very easy. Now, that being said, this was all for this session. It was a very quick summary. And yes, I will see you in the future projects. This was again Ilya, better known as CryptoNap, and have a nice day. Hello everyone, this is Ilya, better known as CryptoNap, and welcome to the fifth and final series of crypto trading for beginners. Today we're going to talk about practice, paper trading, and a few beginner trading scenarios. So, as I said, we're going to talk about the TradingView platform as a free platform that we can practice on. We're going to talk about paper trading, and I'm going to show you how to do it on TradingView, and we're also going to show a few trading indicators. Moving on, so first we're going to go through the presentation, and then I'm going to do the actual showing of the TradingView platform. First of all, what can it be used for? So it can be used for many things. It has a basic plan which is completely free, and then if you want to use more indicators simultaneously, if you want to use it for alerts or anything else, it is gonna cost a bit, but it is what it is. I think the starting cost would be 19.99 a month or something, but you can get everything for free. So first of all, we are going to use it for backtesting. We're going to use it, well, we can use it for running a bot, but you need a paid version for that because it needs to fire off alerts. It can be used for paper trading and it's completely free, and it can be used for gathering information, and I'm going to show you how to do that in just a few minutes. So first of all, paper trading, again, we all know what it is. It's trading with fake money. Now what we need to know is we can do a few things with paper trading on this platform. So we can of course go long, we can go short, we can sell, we can buy. Oh, I'm sorry, I don't think we can go short with cryptocurrencies. I'm not quite sure on that actually. But what I wanted to note is that you need to use the relatable dollar amount to you. So if you're planning to invest $2,000 in the near future, or let's say $2,000 for now, um, you should actually use $2,000 in your paper trading account so it feels more realistic, because we're trying to recreate everything as if we're trading with real money. So that is the most important thing, because the default for TradingView is actually 100,000 units or dollars, and it can be quite unrelatable because you see your gains, you see your losses, you see them huge, and it's not really a representation of how you're gonna feel when you win or when you lose some money while you're trading. So you need to have something relatable, something to ground you, and something to make you a bit emotional so you know how to overcome your emotions. Of course, as for trading scenarios, we're going to go through three of them. So we're going to try to show how to trade averages, so average lines. We're going to show Fibonacci retracements and how to trade those, and we're going to trade on divergences. Of course, the best thing would be including a few or all of these indicators in one. And of course, as far as trading scenarios go, there are many good trading strategies, and people, a lot of people actually are using different trading strategies. It's not like there's one that's profitable and the rest aren't. But I think that this is for another session or another project because it's a major topic, and trading scenarios and trading strategies can actually, I can talk about it for as many hours as you want, and I don't think that I will do it justice by talking about it for 5 minutes or 10 minutes, and I want to devote a series to trading strategies, and I want to go through many indicators and how people can use them, when it's the right situation and when it's the wrong situation to use them, and to lean on these. So that being said, I want to move on. And I want to show you, this is a weird video, okay. I was actually looking for a drop shipping guide because I'm trying e-commerce as well, but that is completely unrelated. It's just related to the video that just popped up there. So let's move on. This is TradingView. So what can we see in here? This is the main page of TradingView, and you see the most popular authors, and you see them trading something, right? So there's Bitcoin dollar trading scenario, Euro to what's called Switzerland's franc. Then we have again Bitcoin to US dollar. So there are many things in here. You can actually filter them, and you can filter them by cryptocurrencies, currencies, or whatever you have. You can actually filter them by a special cryptocurrency. So you can go into, let's say, Bitcoin US dollar, and you can see all of the most recent and most popular ideas in here. See, they're getting liked, they're getting commented on. You can see the views as well. They're showing various strategies and various analysis. So the top authors first, you can see the, when it's posted, and you can see what's expected. You can see the general overview of a certain cryptocurrency. So whether people think that it will be bearish or bullish, as you see, and you can see some news in here. So as you see, it's a pretty broad platform, trading view, but what we're gonna focus on is the charts, right? So let's hop on to Bitcoin US dollar chart, let's say. Okay, there we go. So let us do this, and this is a normal one-day Bitcoin to US dollar chart. Now I have a few indicators in here, but for this analysis we're just gonna use RSI. Let me just actually manually delete these so I can show you everything I want, and so I can draw properly without this distracting you. Okay, there we go. So when it comes to the free plan, you can use up to 3 indicators, right? And this is why I decided to show you how to trade with only 3 indicators, one being RSI, second one and the third one being averages, your averages. So we're going to insert indicators, which is right here, and we're going to type, let's say, so there are, as we actually saw in the previous sessions, we can use weight moving average, we can use exponential moving average, and we can use simple moving averages. We are going to use exponential moving averages, right? Or so exponential moving averages. There we go. And we're going to use 2 of them. Now there are actually indicators that include both of these, so you can actually, with a free account, access one more indicator, and I would probably put volume in there. But yeah, so let's put one to, let's say, 50, and let's put the other one to, I don't know, 21, let's say. Okay, there we go. So if we're moving down to, let's say, a 1-hour chart, or even so a 15-minute chart, because we're trying to day trade, right? Where we're trying to pop up some trades, we can see that I'm going to change their colors as well. So this one will be yellow. Okay, there we go. So the 50 moving average would be the yellow one, and the 21 moving average would be the blue one. Now what we're seeing is the average price of the past 21 candles and the past 50 candles. And of course they're fluctuating, they're crossing each other. And what we can do is we can actually trade their crossings, you know. So as you see, their crossings are announcing that something will happen. So a longer EMA, in this case the yellow one, is showing a longer trade, a longer trend, apologies, and it's reacting very slowly to the movements, while the faster moving average, or the 21, the blue one, is reacting much faster. Now this would be even better if we actually traded something like this. So if we had a 50 moving average and a 7 moving average, let's say, and we can look at what's actually happening. So now if we're going basic, let's say, we can trade every time this short moving average is crossing upwards. We can actually buy something, and whenever it crosses down, we can actually sell something. But that is too basic, and we're actually going to lose money on it. So many people are trying to trade averages. That's not going to happen like this. There are a few scenarios where trading moving averages works, but there are much better scenarios. Why I wanted to point this out is because even though it's not usually not a profitable trading scenario, I wanted to show it to you because many people, many influencers, many YouTubers, many, on every platform, let's say, are gonna try to push some trading strategies, and they are usually not gonna be profitable. They're usually gonna be bad, and they're not something that works in this space at this time. And one of them, and one of the most popular ones, is actually this one. Now, what can we actually use moving averages for, in my opinion? And that is tracking trends, tracking major crossings. So what I would do is I would put a 100 moving average and a 200 moving average, let's say, and I would also put a 50-day moving average, and I would look at the 1 hour, 2 hours, 4 hours, 1 day moving chart, and then I would see the crossings and see the general major trend. Now, this would be an indicator of something horrible happening or something turning into a let's say a bearish trend. Now this is what happened in here, right? The shorter one, the yellow one, crossed the longer one, and this is actually, so the what happened was the mid-December bounced down, then we were consolidating a bit, and we thought, well, maybe we're gonna go up, but with this was the confirmation actually. So right here, this was the confirmation that we weren't actually going up. So this is a very delayed indicator, 100 candles and 200 candles delayed almost, but it is what it is. We can use it to track something down, you know, to look for trading opportunities, and it would usually be used as a confirmation indicator, so to confirm what you're thinking rather to trade on it. Now, what can you trade on? Look at this. We can trade on, oops, my bad, we can trade on, where are you? There we go. Fibonacci retracements. Now, what are Fibonacci retracements? So we already talked about support and resistance lines. And what Fibonacci retracements are basically their principles. So we all know who Fibonacci was and how his sequence and how Fibonacci numbers work. They're basically creating a perfect sequence. Now, what Fibonacci retracements are trying to do is, once we discover the beginning of the trend and the end of the trend, so this is the lowest point of the trend, let's say, so this one right here, we can actually pull them and we can see how much is most likely for the move to retrace. Because when there's an action, there should be a reaction, right? And in most cases, we can see a reaction of it going up. Now, we don't know yet if this trend is over, but once the trend is over, we can do our Fibonacci retracements and see if the cryptocurrency price will move up 23% from the drop, 32.8% of the drop, 50% of the drop, 61.8% of the drop, which is this line, 78.6% of the drop, or a full 100%, which is a complete retracement. Now, of course, people are gonna teach, and many people know about this tool, but not many people actually know how to trade it. So what will they tell you? You see a trend. So our major trend is bearish. We're trading with the trend. But let's look at this. So we have our major trend, which is bearish, right? And then we have a retracement. Let's say that we want to trade a retracement even though we're in a bearish scenario. We want to go long, we want to buy Bitcoin, and we want to find an opportunity. Okay, so we're trying to see where it retraces to, right? We need to know our target. Or even better, if we're in a bearish trend as we are now, we are looking for the price bounce. So will the retracement stop here or here or here? What is going to happen in the future? What we need to know is that we have our confirmation indicators. Also, we have our volume, which is going to confirm that the buyers have stopped purchasing with great strength, or that the sellers have stopped selling with great strength. Now, what I like to do is I really love to pair this trading indicator, well, let's call it indicator, this trading tool, so Fibonacci retracements, with divergences. And what are divergences? So basically, I'm going to draw it out for you because it's easier to see like that. So let's say that the price is going up, right? Okay, the price is going up, but what is happening to the RSI? Like, this is a completely improvised scenario. I'm not looking at the chart or at the price at the moment. And let's say I'm just gonna write actually price. Okay, it's going up. And then we have our RSI, which is this indicator in here that's showing what's oversold, what's overbought. Of course, it's really not a perfect indicator, but it can be used in this case as a perfect indicator alongside Fibonacci retracements. So what's happening now is that RSI is, as you see on the chart, usually following the pricing movement. But if the price starts going up, let's say, and RSI goes down, so goes the opposite way, or in another case, the price may go down and RSI may go up, right? So this is a divergence, and this is a very, very strong signal. Now, there are a few rules. So first we have a bearish and a bullish divergence. So if the price is going down, let's say, and the RSI starts going up, this is a bullish divergence. If the price is going up and the RSI starts going down, it means that this is a bearish divergence, right? It means that the buyers, in this case, it means that the buyers have basically lost their strength. Now, if we pair this with some ranging indicator, um, so we can basically pair it up. Like, let's put it like this. We know that a divergence is a strong indicator of a movement in the opposite direction. So once this happens, what is expected is the price to fall down. In another case, whoops. In another case, if the price is falling down and RSI is going up, what's expected is the price to shoot up. It's not going to happen every time though. And why is it not going to happen every time? It's because divergences happen. They happen on many time frames. They happen in many occasions. But what is going to help us decide if a divergence is tradable or not? Well, support and resistances. If it happens, like if the price is somewhere in here, and the divergence happens, it's in the middle of nowhere. Like there's a good chance that the divergence will actually be responded to price-wise. But we don't need to risk that. We don't need to risk that at all. Now, if a divergence happens somewhere along the lines of support and resistance zones, now this is a very good and a very tradable opportunity, and we have to use it like that. So all I wanted to say is that the chart is two-dimensional. We have time. We also have price movements. We need to include both of them in order to find a tradable solution. We also don't trade off of one indicator. We have uh, indicators that are showing us support and resistance zones. We have our confirmation indicators. We have our volume indicators. And what we really need to do is find our best strategy. Now, I want to talk a bit more about TradingView and what you can do with it. Now, there are many charts you can actually check in here. You can use different type of candles. You can use every single formation indicator or anything you want really. Now, what's really nice about this is that people can create indicators. They are also including many indicators and creating scripts. And these scripts are actually used by bots very often. So you can actually use a bot, something like, let's say, Gumbot, which is including these scripts. So once you have a script and you have a bot, you can, let's say, add an indicator. So these are scripts, and I have a few of them. So let's say we want to see this one. Not a great one to actually show as an example. Let's try a different one. Yeah, we can try heartbeat script, right? Yeah, so this is a very colorful script anyways, but the scripts are usually including many things, and they're showing buy and sell signals. Based on that, you're going to have an analytic of what's happening and how you can profit, or if you can profit, you know. So this is a very interesting thing. Now, yeah, so it would look something like this. So it would show you where you're gonna buy, and it will show you where you're gonna sell. Now some scripts are better, some scripts are worse, but what's important is you can actually program it so you can automatically trade without you actually trading. You can program your bot to trade off these scripts. You don't even know, you don't even need to know how they're made or what indicators they have. So all you need to have is a good script, a profitable script, and a script that was backtested a lot of times and on a lot of scenarios. So that is what I wanted to talk about. You can also use this platform to follow other traders that you like and respect, and you can follow their signals. So that is one more thing. Now, the thing that we're here for is paper trading, and it's very simple to access paper trading. It's right on the bottom, right? So you're entering your paper trading, and you can actually go in here. You can reset your paper trading account, and let's say you want to trade with $2,000. So you're gonna put 2,000 in here, right? And there we go. Our account balance is 2,000. Now you can begin your paper trading journey. So you are gonna go here. So you're gonna right click anywhere on the chart. You're gonna trade, and you're gonna buy or you're gonna sell. These are just quick buttons. You can buy and you can sell your current cryptocurrency chart that you're on, or you can create a new order. So you see you have your asks and your bids, so your sells and your buys. You have your orders that you can have a market order, a limit order, and a stop order. You can use a stop loss if you want, and you can automatically take profit if you want as well. There is also a duration that you can actually put in here, which is quite nice. So there are many options, and you can test this out. You can see if if your strategies are actually good or if they're not. You can see if you begin to be emotional, and you can see how to overcome emotions. Now, I talked a lot about emotions in our fourth session, so our last session before this. You can actually check it out, and you can see what I'm advising on how to overcome either fear or anxiety or rage or self-doubt when you're trading and when you're on a losing streak. I'm also talking about winning streaks and how you can um, have your ego inflated, and how that's also bad for trading and how you can overcome that. So to just sum it up, there are a lot of trading strategies. I've shown you one that I really like. I also have talked a lot about TradingView. I showed you how to paper trade, and I advise everyone to start off with paper trading rather than trading with real money, because they're going to get discouraged really fast if they're trading with real money. Like, trading is actually a science. It's an art. It's something you should devote yourself to if you want to trade like this. If you want to invest, now that's something else that can be much more passive. It takes a lot less time. But if you really want to trade, you have to devote yourself to this. So start off paper trading, start off small, learn how to do it, learn the ropes, get comfortable with the UI, get comfortable with the website, and then you can progress to trading with real money. That being said, thank you for watching. This was Ilya this was Ilya, better known as CryptoNav. And yeah, thanks for watching. This was our last session, and I will see you in the next project. Have a nice day. Bye.